Starting us off, and I'm absolutely delighted, we have Eila Kreivi with us, who's Director for Markets at the European Investment Bank and who's been involved in these discussions from the beginning. She was a member of the TEC and importantly, the technical expert group that started the work of the Commission, but has been very much involved in the whole work of the European Investment Bank in developing its own taxonomy and its own approach to sustainable finance. With that, I pass over to Eila. I'm so delighted you're with us today, and I know you've been supporting our events in the past, and it's always been extremely interesting. Good morning.
Good morning, Nicholas, and thank you, Afore, and congratulations for convening this masterclass, virtual masterclass on taxonomy, or maybe I should say boot camp. But anyways, I think it's looking at the program, also a great mix of speakers here, which is combining EU platform members, other experts, and then also their old friends like Sir Jonathan Taylor, who used to lead on environment and climate at the EIB. Now, if I understood correctly, yesterday, the first day was a deep dive on green taxonomy, which is already quite well known for the taxonomy criteria. And of course, we are expecting fairly soon the other four objective proposals to come out. And today's focus is more on the significantly harmful activities where a change is certainly needed and potential clearly or even tougher rules. And the discussions will also explore the areas with no significant impact. And you might ask, why do we need so many taxonomies? We have green and significant harm and no significant impact and all this. But I think it's because we need to embrace the whole economy, the whole scope of activities. And also we have to stop penalizing or doubting the neutral activities, because I think it will add some clarity to the misunderstanding that has been there for a long time with the green taxonomy, i.e. that everything not mentioned in the green taxonomy is somehow bad or brown or even forbidden. And this is absolutely wrong, as I'm sure you will hear later today. Now, before going forward to commenting on these two other extensions of the taxonomies, I wanted to touch on a couple of points on the overall picture. And of course, the work is not done even on climate or the green taxonomy. We still have some loose ends to tie. And for example, Commission is committed to resolving the question on nuclear and gas and maybe even some other areas which have been a bit controversial. But one should keep in mind this, political passions and political compromises, they are one thing, and investor acceptance is another thing. So the investors who are active in this space, and I know quite a few of them, and their clients, their asset owners, they are attentive to science and to the risks and to the opportunities related to that. And most of them will not accept, for example, gas and nuclear in their green portfolios anyways, whatever the taxonomy says. And the other thing is on disclosures and reporting on green assets. It is very important that we embrace all those who are willing voluntarily to disclose on taxonomy alignment, especially under Article 8 of the Delegated Act. If we reject or carve out some asset classes, be it public, private, small, large, EU or non-EU, the markets will very likely develop just alternatives, and maybe even other jurisdictions will look to leapfrog Europe. And Europe clearly leads in this area, has been doing now so for some years. And we are by far the largest sustainable finance and debt market. And so we should not squander this leadership, because if we dilute it and lose touch with science or make our regulations unstable in that manner, then I fear that the financial market will just they will not only be contented to lobby for a change, they will just go elsewhere and find credible solutions. And all the sustainable market that we have today, one has to remember, has been developed on almost all of it on voluntary efforts. So it is a power to be reckoned with. So that was just some words of connecting to reality. Now, the mission statement for the green taxonomy was always to create a common understanding and a common language in sustainable finance. But this mission, in our view, will only be accomplished with the implementation of the harmful taxonomy and also the no significant impact. Because now the taxonomy tells us which activities are green with which criteria, but it does not say which are at risk of causing significant harm or those who have no substantial contribution. So the binary green or not green will not give sufficient recognition to those who are transitioning from or towards a more sustainable business model. And actually the current estimates, they would put the volume of financial assets that are currently aligned with taxonomy only to 5 to 10%. And of course, this also is due to the fact that so far we only have the climate criteria. Now on the harmful and no significant impact at taxonomies, let me touch upon a few points on how it would look from the viewpoints of investors, from supervisors like central banks, and then also borrowers in the financial markets like us, but not only us, but many others. So this is as a proxy for all financial market stakeholders. Investors first. You know that the investors have already created some kind of proxies for their own harmful activities. But the outcome of this is, of course, far from optimal because it's individual action and it doesn't lead to any coordinated or commonly applied approach. So investors do not only state in what they will invest, but they also say or create the so-called exclusion lists. But these lists are not following a methodology. They are usually value-based. So we do not want to invest in tobacco or arms or gambling or alcohol, etc. So this extended taxonomy would provide actually a science-based standardized methodology for the negative ESG screening for investors or any other stakeholders. And then you can add to that your value-based criteria if you want. So the second point, central banks, what could be their take on all of this? Now, the BIS, Bank for International Settlements, and the Banque de France, last year, January, they published a book called The Green Swan, Central Banking and Financial Stability in the Age of Climate Change. Now, central banks have a different angle, obviously. Climate change, for example, is a threat to the mission statement to maintain financial stability and price stability. And climate change has been already recognized very clearly as a risk to financial stability. And it could be even the root for next systemic financial crisis. But even looking outside, looking at the price stability, because climate change and any environmental crisis can directly affect inflation. For example, if we have floods or droughts, which destroy crops and raise food prices, we already have seen this happen there sometimes in the past years. And also the mitigation policies can all affect consumer prices such as electricity and petrol, either directly or indirectly, and this would go into higher production costs and into consumer prices. So these issues very clearly are in the traditional mandates of any central bank. In addition, the effectiveness of monetary policy could be seriously hampered by the impact of a climate-related structural change or biodiversity-related change by a disruption to the financial system. For example, losses from disasters, for example, for insurance companies, or stranded assets could impair credit creation. And this kind of crisis could be extremely difficult to predict because it has so many various dimensions and also so many interdependencies. So central banks, for example, in the EU, who are planning climate stress tests for banks, they are very keen to see better disclosures on the harmful activities, because that will tell them more about the risks that I mentioned, and especially, for example, on the stranded assets. So they are probably more keen on the brown side than the green side in order to assess the risks. And in order to give an idea, sort of money-wise, what we are talking about, late last year, the Financial Times in the Lex column was forking out some numbers, and they estimated that some $900 billion or 1/3 of the then value of big oil and gas companies could evaporate into thin air if governments really push for the 1.5 degree restriction in the rise of temperature. And with that 1.5 centigrade threshold, that would leave over 80% 80% of hydrocarbon assets worthless. I think this is just staggering numbers. And even if we contented with a 2-degree rise, energy producers would still have to write off half of their fossil fuel reserves. So you can see that this could really be another subprime crisis or that magnitude, and which is why central banks are very interested in disclosures in the harmful brown area. Now, another problem for central banks is probably that the credit risk or the traditional risk assessment, the methodologies that we have, they can't really, it's difficult to extrapolate the future systemic impact because we did not use to assess these risks. They were not part of the methodologies. So they are in totally uncharted territory. So they may find their powers a bit limited when it comes to green swan events. And they might even need to think about extending or changing their mandates. So this kind of climate stability and environmental stability should be considered as a public policy goal and be supported through coordinated measures and reforms in international monetary and financial system. But that needs also the support of frameworks like the extension of the taxonomy that we are talking about. Now then, the financial, the debt market, sustainable debt market, what is the angle from there towards these extensions of taxonomy? There was the bank, French bank Natixis made some research 2 years ago into the greenium, i.e., what is the pricing advantage that the issuer gets when they borrow in the green format, and they highlighted that there is a correlation between the level of greenness of the assets and the cost advantage. So the greener you are, the better chances you have to get a greenium. The financial advantage has been discussed very widely in the recent years, especially for corporates. Does it make sense for them? Do they have enough of greenium? Is there greenium, and how can they make sure that there is one? So I think with the extension of the taxonomy into the harmful areas and even to the neutral areas, this will improve further the disclosures and will allow the market to consider a finer pricing and pricing differentials. How would this be? Let me delve into that. Now, we have all heard plenty of talk about greenwashing, and usually the greenwashing, when I have seen it happening, it's not so much about having bad projects which go into green bonds. It's more about the issuer's overall activities. So if there's an entity who carries on with harmful activities for a big part of the balance sheet and then does a green bond with their left hand, we need to understand what are they going to do with the brown activities. Will they, if and how and when, wind down? And is it even possible to wind them down? So this harmful taxonomy should provide a scheme and a benchmark for those questions. And we don't get this yet from the green taxonomy. So there is a lot of uncharted water and territory in between these different areas. And this take on the entities and issuers and all of their activities is not only what you want to flag as your green credentials. This is becoming more and more common because we have seen in the recent past the cases of Shell and the court decision, the ExxonMobil board decisions. Australian government has been sued by some of their own school children, and they get pressure from international investors. So not even governments are safe from this. This doesn't only concern corporates. So this activity of looking at not only of your green activities, but also of your brown activities, this is the trend. And, coming from the financial market background myself, there's a trader saying the trend is your friend. And this is very much applicable in this case as well. So stay on the good side of the trend because you can't fight it. So just to say a few words, what is EIB's take on these different areas? So we have said that from the beginning of this year, all of our projects need to be Paris aligned, and they can be Paris aligned in two ways. So either they are positive for or helping to fight against climate change or other environmental aspects, or then and that should be up to half by 2025. But the other half also needs to be at best neutral, so they should not do any significant harm to any of the environmental objectives. So either you are green or you are neutral. So we try to walk our talk, and we have committed to be aligned with the taxonomy, which have a taxonomy, without even having a good impression of what it will be in its completeness. But we are the EU bank and EU climate bank, so it's a natural thing for us to do. So now coming back to that pricing. So, for example, our green bonds and our sustainability bonds, they are the investor there has a credit risk of EIB, not a credit risk with the allocated project. So in credit risk perspective, they are comparable to any other bonds of EIB, and this is likely, of course, to keep the potential greenium within certain boundaries. But the credit risk of the issuer can be then perhaps reassessed if we get the, let's say, brown taxonomy. Sorry, Nancy, but I just use this for being a bit shorter. Because if you have disclosed your harmful activities as well, then the market and the investors will have a better idea of that entity's actual credit risk. So we have a better tool for assessing the overall picture. And one cannot anymore say that you can do green bonds which are in isolation from the general activities of the issuer. This is already happening. This is happening. This was the proposal in the TEG proposal of the green bond standard, and this is also what the green bond principles is now recommending. So from our point of view, what we believe that the extension of the taxonomy into the harmful and to the neutral areas can and will do is help define the economic activities that do require policy interventions and support for decommissioning, for example. And also it will help to identify those still far too many subsidies that are there for harmful activities. It should also help to provide transparency in environmental performance and also distinguish those activities which have a low probability of any significant negative or even significant positive impact on the environment. And this is very important that we do not penalize them. And also this will clearly contribute to better risk management and risk assessment by everybody, be it investors, banks, central banks as supervisors. So we think that this will be a very useful part of the palette of the tools. So with that, I will give over to Nicholas and then to the panelists who will make a deeper dive into this topic. Thank you.
Thank you very much indeed, Eila, for this overview and I think very succinct justification, explanation for the need of a high impact taxonomy, because I know the jury is still out on that and the Commission will not decide on that, at least formally, until the end of the year. Maybe I can do one follow-up question before I pass over to Nancy to kind of go into some of the work of the group in more detail, which is I was staggered by the figures you mentioned about the fossil fuel industry, the 900 billion or the 80% of assets that become effectively valueless. And this question, which is, transparency is good. I think transparency makes a lot of sense. The question is more, what do we do with that transparency? Because even if policymakers create, let's say, shielding mechanisms or bridging the transition and so on and so forth, as you say, markets are sophisticated. Once they see this, they will price assets in the way that they think they should be priced. And that immediately brings us to this fear about legacy assets. And legacy assets sitting on pension funds. And then you kind of, in a way, help to solve the environmental problem, but you create a whole new social problem because pensions values will immediately drop significantly or investments will drop. How do we deal with this kind of transition of phasing out these assets without having a massive cliff effect, whereby the markets kind of immediately downgrade or downvalue those assets?
Yes, it's a very good question, but also I think we always talk about all these risks, of course, because they are the headlines, easier headlines, I guess. But there's plenty of opportunities here as well. The new, let's say, the greener economy, greener environment, greener technology offers plenty of jobs as well. So we should not forget that at all. And I think we have been through similar kinds of transitions in the past, maybe not on the same scale. And we saw that, for example, if you think about mobile phones, when mobile phones came, then people, in a fairly short space of time, people who produced or installed landline phones went jobless because nobody wanted them anymore. But somehow they got integrated. We got so many new services and so many new activities with the mobile phone that probably compensated or more than compensated for the losses. This is clearly a job for the public sector because supporting the people who suffer from this, or the regions or even countries, this is something that the public sector needs to do and see that nobody is left behind. And this is the phrase you hear very often. What it means in practice is sometimes a little bit less clear because it depends on the region and it depends on the people, what kind of educational level they have, how quickly they can be transferred. But I think one should not just, lean back and say that, well, this is getting too costly, because the other cost is also going to be huge. And for example, if we think about, let's think about biodiversity. If we destroy biodiversity, there are a huge, I think it has been estimated 1.5 billion poor people in the world get their living from forestry and agriculture. And if we destroy this, they will go unemployed. This is also a cost. This is also very expensive. So it's whatever you do, you will have a cost, and we just have to decide which way we want to go. One is where we have the cost and we are driving ourselves into the wall, or then we have a possibility where we have some costs, but we also have opportunities and we can see the future. So I know which way I would rather take. And this is, I think, what is forgotten. We only talk about the costs. It's not only that. There is also a way out of this, and that's what we should take. But there we should have, private sector should be working here, but also the public sector. And as I said, governments are not safe from this. So governments will also have to not hide under their just that we are the governments and we don't need to do. You also need to do as a government what is needed from you. So I don't have a quick solution today, but I do believe that solutions can be found.
No, and thank you very much for the positive outlook. Yes, I think when I say cliff effects, it's just that we manage it, that it doesn't happen overnight, so to speak, that there's also some transition in phasing things out. But you're absolutely right, and the EIB is leading, I think, the work in the public authorities. I know there's always been this trade-off about extending the taxonomy to the public authorities, and thereby then some enthusiasm making the taxonomy maybe less ambitious because suddenly public authorities are caught by the same obligations. That'll be an interesting debate at the end of this year or next year, whether we can extend the taxonomy to the public sector. Thank you so much, as always, Eila, for these very interesting introductory comments.